Hi everybody, welcome to the Finance This Property That podcast. My name is Dion Fernandez and I am a mortgage planner and finance professional. My goal is to empower financial legacies for generations, and I look to do this by using my over 13 years experience in finance and having special guest speakers like financial planners, accountants, buyer's agents, family lawyers who are experts in their field to provide knowledge and free education. And without further ado, let's get into our episode today. Hey everybody, welcome to this episode of Finance This Property That. It's our panel episode. I know you guys are all eager to see our four smiling faces. Today, we are covering off rates, rentvesting, LMI waivers, and stamp duty clarification on some stamp duty exemption. Welcome, lads. Ladies and gentlemen, gents.
Thank you.
Thanks, mate.
We must have done something right last time.
Well, this is the third one, so you got three, so it's good. The temperature is 16 degrees again for
Just took
all
my
those playing
puffer
at
jacket
home.
off as I walked in, so might need to put it back on shortly.
It's warmer when there's four of us here, right? And this light is like pretty warm. But guys, what a crazy month. Lots has happened. I feel a bit overwhelming,
I can't
really.
believe it's been a month since we were last here.
It's
having a
fine.
chat. Yeah.
Yeah, it really has. Lots has changed. So I'd really love to go through a couple of things. And, obviously the big elephant in the room is the rate cut, the RBA rate cut of 0.25%. Not going to dwell on it too much, but just get an idea of what you guys seeing. What does it actually mean? Is it significant enough for people to start making major changes to the way they're repaying their home loans? Or let's just take it away. Simo.
Yeah, I mean, it's definitely been a welcome change. I'm sure we can all agree on that. It's been a few years now where rates have only been going up, so it's good to see rates can go down, which a lot of people I think are happy to finally see. It's been really good, and I think I'm sure we'll get into it more later. But although it hasn't been a massive difference to people's back pockets, I think it's certainly helping everyone's sentiment and I guess positivity and where things might go this year. So I think that's been good.
It almost has felt like this pressure valve has just slightly been released. But I know for me, I just think let's just don't make any changes. I don't. Especially around repayments. Yes, there are some banks that won't actually change your repayments, which is you've got to go and change them, and I think that's a really good way to do it, because then they can have a conversation with you as to do you really need to do it. I know I wouldn't be changing my repayments because I don't think it actually changed them all that much anyway. I think it was like $20 a month for me anyway.
Yep. And look, that's been a good opportunity to touch base with clients. We've had a lot of inquiries. I think my first inquiry was about 2 minutes after the RBA announcement and it hasn't stopped since. But it's been a great opportunity to reconnect with clients and I guess add some value around what that change means. And we haven't had a rate cut for 4 or 5 years. So, some of us are a little bit rusty around how it works. And, I even thought all banks would just pass it on and amend repayments straight away. But as we've seen, some banks aren't. So if there are any clients out there, wondering when theirs will change, they have all passed it on in full, which is great. They've all passed on the full amount, the 0.25, and it's all in effect now. So that was the other, misconception is people think it changes straight away. But there were some banks that were only changing this week or passing it on this week. So do link in with your lender and have a look at if your repayments have changed, because there has been a bit of uncertainty around that. If you do want it changed, you can speak to them about reducing it back to the minimum repayments, which will drop it based on the rate cut.
Yeah, and look, shout out to the big banks, CBA, Westpac, NAB, ANZ. They may not get the credit like that they do, but they all put them down pretty much straight away. Within about 10, 15 minutes, they're like, bang, we're putting it down.
Yep.
And it's and they told you the date. It was this. People, you're never going to please everyone. Well, why can you put it up? Why can't you put it down quicker? Well, there's stuff in the background that has to change. You can't just turn a key. And
that's right. It was the same the other way too, though. Like when rates were going up, it still took a couple of weeks for that to, for the banks to, change all
rates.
And then you didn't actually see the flow-on effect till a month after that anyway.
And that's always the other misconception is that, the RBA happens like early Feb. It might not, mid to late Feb. The change might not happen till late Feb, early March. So most clients are already partway through a repayment period. So then there's an update of repayment for next month, which includes the less interest, but then it takes like 2 or 3 months for the repayments to sort of normalise out based on the new rate. Because obviously interest is calculated daily on loans and charged monthly. So.
Exactly. I guess for me as well with, a 0.25 deduction, I'm going to throw it to you, Luke, because you deal with a lot of first home buyers. I mean, that's released a little bit more borrowing power. It's not significant.
No, it's not, but it is an improvement.
Yeah.
It's nice to have something really positive to talk about of recent times, because a lot of the conversations that I do have with a lot of first home buyers is the lack of borrowing capacity and letting them know and having transparency around that, which is a hard conversation to have sometimes, and to spin it positively can be a challenge. To have a rate cut, come and be like, oh, hey, your borrowing capacity is increased by, on average, I'm finding probably about 15 grand of the average person. So, it's not life changing, but it is something, and it brings a bit of positivity to things.
Well, exactly. And I guess then when you pile everything on the some of those significant changes for first home buyers, do you just want to quickly run through a couple of those with the stamp duty waivers and things like that as well? We've talked about it. But let's just
there has been a recent change in that space. So if you're a first home buyer and you're looking to build your first home, as a way the government, I suppose, is trying to increase the amount of housing in Queensland, is they're trying to promote building. So they're actually waiving stamp duty. Doesn't matter what the value is across the land and the build total, the stamp duty is waived. So
I could go buy $1 million block of land and build for another $1 million, so a $2 million house. I do not pay stamp duty on that.
The main thing is that you're going to live in the property, so that's the key part, not for investment.
Well, I mean, that helps those people that can't, that have pretty much knocked themselves out from getting all the other grants, right?
Correct. Yep. So most of the grants sort of cap out at 700,000, and then with the first homeowners grant of 30K caps out at 750. So it's pretty hard if you're looking to build in Brisbane to fit within that budget and price cap.
I mean, like that. Someone needs to talk about that. That really needs to shift to something more like 850 to 900. That needle needs to move.
Yeah. I think if I could make a change in that space, would be to increase the price cap to follow New South Wales with the first home guarantee scheme. I believe that's around 800. So that would really help to get more people into the market.
Which just opens up a better quality asset.
Yeah, correct.
It also is eligible for knockdown rebuild. So if you're buying something effectively a new build, and there's no cap. So I think I was looking at some numbers the other day. There's not that many people as first home buyers buying a $2 million property, but as an extreme example, it's about an $85,000 saving on stamp duty. So there's plenty of builders out there that are building new and selling. So if you're a first home buyer, there's no stamp duty applicable on that as well.
And working in our team, we've got access to the buyers agents, builders, real estate agents. Just ask the question,
Builder brokers.
I
think the rate cut has been good, just with a confidence thing, like Simon was saying. We've had the 13 rate rises. People, when they're talking to us around budgeting, and a lot of people are coming from a renting, especially first home buyers, they're paying X amount per week in rent, and they're wanting to equate that to a mortgage and wanting to cap it at a certain amount based on their budget. So it's been really hard for them to be budgeting in an increasing interest rate environment. I think the rate cut, although it's only small and maybe we'll see a few more in the next 12 to 18 months, but I think it just really caps people and says, okay, well, now we're probably on the downward slope. So at least when they're budgeting for their monthly repayments on their mortgage, they know that potentially is the top for the next couple of years. It's not an unknown.
And we just it's about the education. Just be smart. Just because it's dropped doesn't mean you can now just spend it on everything, right? You still need to be diligent.
I understand there's probably a lot of families that have been hurting through the rate increases. So I can understand them wanting to reduce their repayment if they can. But I think if you've got capacity to keep that same repayment, you'll find that you'll probably shave a couple of years off your mortgage.
And interest, don't bother paying to the bank. Just pay it off. Pay it off your loan.
Yep, exactly.
What else have you guys seen? Is it what sort of conversations have you been having, or what questions have been clients asking around their situations?
I think most of what we're saying here, but, I did get a lot of inquiry about people wanting to come back and recalculate their borrowing based on the rate cut. So, a few of those people who were really trying to push their budget and stretch to, let's face it, afford some houses around Brisbane, they wanted to see what it looked like with the updated rate cut. Unfortunately, it's not a massive difference, but it all adds up. And, again, it comes back to the positivity and, at least helping them, that little bit, right?
Well, yeah, there's been a bit of commentary around or suggestion around, the rates are dropping, therefore the prices of houses will go up. You guys, what are your thoughts on that? Like, it kind of annoys me to see a few real estate agents, like, I know they've taken these videos down since then, but partying saying, rates have gone down now, like, we just closed this deal $25,000 more. I'm like, God, that's the wrong message to be sending out, right? Like, geez. And it was very promptly taken down after that. But you guys reckon that's a thing, or is it just natural?
I'd say a massive change. I think, Brisbane's just got the drivers anyway, right? Like, there's a lot of good things happening for Brisbane at the moment. So I think that's, the underlying supply and demand. I mean, the reality is we just don't have enough homes, right?
No.
We've got a lot of net migration, both, interstate and internationally. So I think that's driving it, more of the supply and demand. The interest rate is probably the sweetener on top, right? But it's probably not the decision making. We've had quite a lot of clients ringing, like checking in on their interest rates and looking at, would refinancing be an option? But again, I think we spoke about it last time. Like, we've got a really good sort of post-settlement review process. And, I've been finding with a lot of my clients, they're already on really good rates because we've been on it.
Yep.
So there's been, again, good opportunity for discussion, but hasn't been too much need to move when there hasn't been huge savings to be made because we're on it.
Yeah, exactly. And I think you hit the nail on the head there in relation to, should you refinance? Well, if it's not going to be, it's not going to put you in a better position.
Correct.
And it's not going to, I guess, be in your best interests if the costs are more than for 0.25, and if that's all you're moving for, if there's no debt, if there's no restructuring, you don't want to buy another house, we don't need to release some extra borrowing capacity or equity to do other stuff. It's pretty hard. It's pretty hard to justify moving, right? Like, look, there are some people that'll do it, but I don't know, for us,
it's got to justify the switching costs, right?
Yeah,
That's like $1,200 on average. So.
And look, it just depends on the loan amount, right? If someone's sitting at 300,000 or 400,000, it might not be worth it. If they're sitting at $1 million, there could be some benefit. I guess our role is to give the client the information so that they can make an informed decision and not sway them either way. So
banks have been really hot with retention.
Yes.
I had a client come to me, not an existing client of ours, and they wanted to look at refinancing their Westpac loan, for example, and they were sitting on a pretty high rate. And I said, look, I just gave her what she should say to the bank. Contact them, say this, looking to move to X bank at this rate, and see how you go. Just give them a chance to retain the business first. And if they're not willing to come to the party, well, then you're well within your right to look at refinancing options. And we found like the rate that they come back with was better than their advertised rate. Finding that the banks are really hot at retention.
Yeah, and that's a great win, right? Like, you have proven yourself as a trusted advisor because you're not just refinancing them for the sake, you've given them an option.
Yep.
And that's less work they have to do, it's less work you have to do, and they win.
Yeah, correct.
At the end of the day, they've had a win, and the bank's had a win too. They've got to retain a client because it costs them quite a bit of money to lose clients, right?
Yeah, correct.
So, couple of things that I'm sort of also seeing some policy changes because I love, keeping cross policy. Couple of the lenders changed their LMI. Lenders' mortgage insurance waiver policies for professionals, and some have actually added some other ones. So there was a great lender that already had an LMI policy for nurses, paramedics, etc. Now there's another lender that's come on board, which will open up a bit of competition. I feel.
Good to see.
Yeah.
It's communication come out yesterday with one of the big four banks that they're looking to extend the LMI waiver to your nurses, paramedics, police officers, firefighters. I believe that they're willing to go up to 95%, which is huge. I don't think any other lender is offering a 95% no LMI product for those.
Not for those particular professions. It's 90.
Yeah.
90
so the key thing is that you buy the property to live in. It's not for investment. can also refinance up to 90%. So yeah, if you fit any of those professions, now's the time to be reviewing things and perhaps looking to buy that home to live in.
Yeah, and there are some other parameters that you probably have to meet, but again, it's about a conversation. Is it the best fit? And then another major's just opened up their professional package as well, where they were very, we can only have the top tier. It's now opened up to, your accountants, they had to be partners, solicitors, they have to be partners, but now it's a bit opened up, more aligned with some of the other ones. That's going to make a huge impact, especially around debt structure and strategy.
Yeah, correct.
Yeah, the professional ones are good because, they're not as restricted as the emergency workers that Luke was just talking about with the owner-occupied only uses. Like you can kind of use them and recycle them to build out a portfolio, which is pretty exciting and an awesome leg up.
Yeah, and a lot of those ones are going to 95%. So I've just done a bit of a debt restructure for a doctor, and they're actually with a major, and they couldn't untangle all their loans. We've untangled all their loans. We could actually end up going to 93% on their investment property, no LMI, still have the same rates as the 80% because they're a doctor, and then restructured some debt, paid some owner-occ down, recycled it out, and now we're setting them up for two more purchases, and that's just a bit of extra research for them. That's knowing that you can go up to certain professions and go up to 95. That's cracking, right? And there's no change.
I think it's really nice recognition for those emergency services as well. Like I always get asked, why does a bank do that? Obviously, they're trying to attract that demographic into their bank as a clientele, but I guess the thing they like about those professions is that they're always going to be needed, and we've seen that through the years, nurses and doctors and things like that. So it's also nice to get some other professions, not just medicos, into that LMI
100%.
waiver. I mean, we're all waiting for mortgage brokers, but no bickies yet.
We'll be waiting for a while.
We're not essential, obviously.
But the next cab off Aranco.
But it's really nice to see that, and I guess it's a great talking point. We do a lot of that sort of business, and a lot of our clients are in that emergency services space, and it's a really nice, I guess, way to talk to them, and I guess, thank them for their services, and especially with all the stuff that we've had going on in Queensland in the last couple of years and post-COVID. I mean, you looked at hospitals and things, they were so essential, right? So I think it's a really great offering, and just allows people to get in with smaller deposits, which allows them to get in potentially quicker and start really building wealth through property.
Yeah, and especially with the first home buyers, you may not have to rely on just... Because with the scheme, there's only certain lenders on it, right? And this is the same with the LMI waivers, but got a bit more option and flexibility, right?
Yeah, there's no income cap threshold. Typically, for this, with the paramedics and nurses and firefighters and stuff, there's no income cap threshold, whereas there is with the scheme. There's no price cap threshold either. So it opens more doors.
Just another solution to take that first step.
And look, LMI is not a bad thing, right?
Absolutely not.
I've paid LMI on properties before, and it gets you into the market earlier, or gets that asset into your possession earlier, so you can start getting the capital growth on it. But I guess all of these policies just give us more arsenal to be talking to clients around, is it a grant, is it a scheme, is it a guarantor, is it an LMI waiver? But I mean, if they're paying LMI, that's not a big deal, because they're getting access to that property earlier.
Right.
And, we've seen with the market over the last few years, if you keep saving for that 20% deposit, you're almost chasing a runaway train, right? By the time you get there, the property's gone up. So you then got to keep saving. Money. Correct. So, we do a lot of work around educating clients around, is it better to buy now and pay a little bit of LMI, but then start, paying off your own loan and building equity that way, plus also the growth of that property. So I'm a big fan of LMI, just to allow people to get access to property quicker and earlier. It's time in the market, right? Not timing the market. So.
And LMI is an enabler, not a disabler.
Correct.
It gets you. And when you think about it, what's the average LMI? 6 to 8%.
Not even that.
Not even
it's
that.
Like 2%, 2 to 3%. Yeah.
But if your property is growing by 6 to 8%, and you paid 2%, you're up 4 to 6%.
Yeah.
Right. You just have to have the patience to
There's
ride
an opportunity cost there.
Yeah. Correct. And again, this is the education piece. Have a chat. Let's find out what, we don't deal in transaction. We deal in debt structure and strategy. This is what we do.
And there's still the misconception. I mean, I think you guys spoke about last time around, you have to have a 20% deposit, but there's so many options available now for people to get into the market. So it's such a great time to
We've
be
just
buying.
talked about two.
Yeah, exactly.
Yeah, you LMI waiver or we just pay LMI. There's pretty simple options, and again, what option's the best? Have a chat.
Yeah, exactly.
Depends on your situation. But again, there's a lot of people, like what you're saying. People are currently renting. They're renting and trying to get in on their first place. Now, 50% of us on this couch do this strategy at the moment. So Rentvesting, it's a really hot topic. You've talked about it on your socials.
Yep.
You've gone and done it, and I'm about to do it. So
Now I feel like I should do it.
well, I'm
Thanks,
pretty
guys.
sure that you're the next cab off the rank, aren't you?
Apparently.
Soon, allegedly. No. So let's talk a little bit more about that, because again, it is a good strategy. However, it's not for everyone. But if you want to move the needle, let's talk about the numbers, or let's talk about high level. What is it? So you've just got and done it.
I guess, I mean, I'll talk about a client firstly. So I had a client, it was a single guy who's, earning good money. He was living in a share house with a bunch of mates. They were, having a great time in a really premium location in Brisbane. And he was talking to me about buying his first home. And, we ran the numbers, and where he could afford to buy was going to be about 25 kilometres out of town. And he said, if I bought out there, none of my mates would move out there with me because it's just too far away. So in a situation like that, and that's, I guess, what I like about Rentvesting, is you rent where you want to live or that works for your lifestyle, but then you still invest elsewhere. And so, the old saying, rent money is dead money. There's some merit to that. But I guess if you've got assets elsewhere that are growing and you're in the market getting that growth, then there's no real difference, right? Some people would say paying off an owner-occupied mortgage is dead money because there's no tax benefits to that, right? So I think it really depends on your situation. For us, we were looking to upgrade a property. We wanted to be closer to the kids' school for a couple of years, but then we'll probably move back into the area that we were previously living because that's where the high schools are, right? So instead of selling, rebuying, and then selling and rebuying and donating a ton of money to the government for stamp duty and paying agents' fees and whatnot, it just made sense for us to retain our existing property that we may end up going back to and getting another property in the meantime as a rental. And it's an opportunity for us to, I guess, experience a new location and see if that's what we want to do. I guess we see so many clients jump into their property purchases and they don't think about their future life stages. What's going to happen when we have more kids, or we move jobs, or the kids are at school? Is this location going to be ideal for that scenario? So I guess Rentvesting just gives you a bit more flexibility. Yep. Yes, there's the downsides. You can be kicked out potentially, but in most cases, you can sign longer leases, or at least you've got a lot of notice to move. So I guess that's what is working for us. We were able to upgrade our house with not that much extra outlay per week. And you do the numbers on owning it versus renting it. And especially when you're in some of the more premium locations, it's a lot cheaper just to rent those properties, And so you remember, renters pay for the accommodation, not for the land. So yes, they will pay more because it's in a more premium location. But, if it's a big block or, a small dwelling, you're not going to get as much rent. And so we typically see houses, they don't get as much rent as units because based on their net return, because obviously the owner has paid a lot for the land. So the renters aren't usually going to pay more if it's a bigger block. They will pay more if the house or the accommodation is better, but not necessarily the block. So
yeah, because I ran the numbers based on my little scenario, and if I had to go buy a property, the property that I'm looking to rent, go for 1.4 million, right? You have to buy that plus stamp duties like 60K, all the expenses, 1.46.
Yep.
Say average rate 6%, 8,700 a month.
Yep.
Rent's like not that, it's half that.
Yeah, correct.
So I'm renting at 3.75% yield versus paying 6%. So makes sense,
That's
right?
it.
So I mean, my position's very different, but
So if you can go and buy investments that are returning 5 or 6% and you're only paying a yield of 3%, well, then there's an arbitrage. There's an opportunity there, right?
yeah. And also for us, it was more of a fresh start.
Yeah, correct.
Yeah, for Charlotte and myself. So thought, there's a nice pool 15 metres down.
Plus, you can say you're a rentvestor.
Yep.
Oh,
good. Yeah.
That's exactly why I did it.
All for the
It's the main
podcast.
reason.
It is. Well, I guess, we talk about it, but how many brokers out there talk about investment properties, etc. They don't even have a property. They don't even have one property.
Yeah.
Right?
Yep.
Whereas, we can talk about rent vesting, but have you actually done it? Have you pulled the trigger and actually gone, hey, look, I'm going to see, it makes sense for me.
Yep.
But we don't think that way sometimes because we're in the game so much.
And look, that the numbers might change when rates come down more, right?
Yes.
When rates are high and mortgages are high and you can rent cheaper, well, then there's an arbitrage there, right? But if rates are at 2%, it might just be cheap to just buy it yourself, right?
Yep.
So it's probably something, that's what I like about it, is you've got that flexibility. And let's be honest, like we look at clients' borrowing capacities, they've usually got more capacity to buy an investment property because there's a rental income attached to that, right?
Yep.
So if they've got no owner-occupied debt, then that potentially increases their borrowing capacity for future growth of a portfolio. So that's what I'm hoping to achieve with it as well. We've got a few projects on the go. So instead of tying all of those funds up in an owner-occupied property, we can go and do some other projects. Right?
And like you said, it doesn't work out in 12 months' time or after 2 years when you've out, your kids are moving out of that school, going to high school.
Let's move back.
Back to your property.
Yep, that's it.
But in the meantime, take advantage.
Yeah. Yeah. From a first home buyer perspective, I've found rent vesting to be really helpful for a lot of the clients that I'm talking to that can't afford to buy a property in Brisbane based off their income only. Because what I'm finding is for a single income earner wanting to buy a property in Brisbane, they want to be earning 110, 120 minimum, which not everyone's on that sort of money.
Yeah.
So to create a solution for them so that they can actually get into the market is they're either renting a property or they're living at home with mum and dad, perhaps paying board or no rent at all, and then buying a property in an area that suits their budget. So whether that be like Toowoomba or up north or WA, that's been a really good way to be able to help them get into the market, and they can hold it for a couple of years and decide to maybe sell that and then come with a bigger deposit once they've got more income, and perhaps they can buy something in the area that they want to live in.
Yeah, and there are lenders out there, and in that situation, if they're single, no dependents, living at mum and dad, they'll actually, with a letter from mum and dad or a stat deck from mum and dad, not even take into consideration the national rent. That's another $650 per month that that you can work with, right?
Yep.
Again, debt structure strategy.
And look, if you're buying an owner-occupied, you're going to be restricted based on cost, right? And where the livability for commuting to work and family and friends. Whereas if you're doing it as a rent vestor, I mean, the country's your oyster, right? You can be buying wherever, based on data or growth or
Whatever your goals are.
Yeah, that's it.
And you're not, and it's all that pre-tax versus post-tax repayments, right? Like when you've got the investment, it's all that's your pre-tax. It's all with pre-tax dollars.
Yep.
Whereas, you're paying a post-tax. But either way, they serve the purpose. Those loans and that property will serve a purpose. Owner-occupied, as Aaron Christie David says, it's not dead debt. It puts a roof over your head.
Yeah, correct.
That's the purpose. There's that debt that's
that's
serving.
right.
Cool. If you've outgrown that purpose, now it's an investment. Now it's a tax deduction. That now it's working as an investment. So now you're treating it like a business and rolling that one forward. So I think it's a good idea. Like it's not for everyone.
No, that's right.
And again,
And it may suit you at different stages of your life, right?
Correct.
I mean, I even feel it with the office, right? Like we bought the Emerge office a couple of years ago, and we've had really good growth the last couple of years. So it's probably at a stage where, as we keep growing, we'll probably need another office, right? So, but I've gone and bought that place. So it's like we can't keep adding more stories to it, right? So we've almost got to go elsewhere at some stage, right? So, but then when you own it, you're almost committed to staying there because it's an asset that you own. So, maybe in a business sense as well, like the growth of it, still owning business assets or commercial assets from a returns perspective, but. If you're a growing business, it's tricky you're either spending more to upsize the office, and then the first year or two you might be, your cash flow might be a bit tighter because you're not filling the office. But then if you buy something too small, you're going to outgrow it, and it's no different with a home, right? And a growing family.
Yeah.
So.
You can only just put so many rooming houses out the back.
It's a hard one to weigh up.
I might ship Dion out there
Yeah.
to his office afterwards.
Put my tent out there.
Give him an EV charger and away he
That's
goes.
all I need. EV charger, maybe a generator.
Look, the rent vesting, obviously everyone's situation is very different, right? But I guess that's what we love helping people with, and opening up that opportunity and saying this is another option for you guys if you want to continue building your portfolio or using that equity for other property purchases. businesses, right?
Because in general, the rent's probably less than what an owner-occupied property would be, and without the interest being charged and loaded and, and things like that as well. But yeah, look, I mean, that's I love having these sort of healthy conversations because this is what clients want to know. Like who's done it, what we're doing. We add some credibility when you're actually doing it as well. It's like when you own a property. But yeah, look, and speaking of credibility, we're nominated for some awards. That's great. Mate. Let's celebrate some success. Luke.
Yeah.
You're nominated.
So I think that's next week too.
Yeah, it
by
is.
the way.
Yeah.
So yeah, us
Dust
as
out the
a
tux.
team are up for how many awards?
6.
6 in
Yep.
total.
Yeah,
which is huge. So it's a massive credit to our team, like from the onshore team to the offshore team.
Yep.
It's huge. So it's nice to be able to get some recognition, and so Adam and I will go along next week and hopefully bring home a suitcase full of
home the
trophies
goodies for us.
and see how we go. We might come back with nothing, but either way, it's great recognition for us and the team.
So
Yeah,
what
that's right.
what award has Emerge been nominated for?
Yeah, so personally, I'm up for Wellness Advocate of the Year, just through the stuff that I do in the first home buy space, which is really cool.
Yep.
Yeah, and I'm up for Resi Broker of the Year for Queensland, which is pretty exciting. So again, like they're an industry award, but I think it's a recognition for our whole team and especially a lot of our processing team because we can't help clients without the support of them. We're up for customer service as an office, which is really exciting. So that one was something I was really passionate about. It's a real focus for us in the business. So that was cool to get that recognition. We're up for Boutique Office of the Year, so sub 5 brokers. So again, that's a really good one for our team to see that we're adding value to clients. And then I'm up for Mentor of the Year as well. Because of this bloke here, trained him up, got him going.
Didn't fail, so that's good.
And then we're actually up for Thought Leader of the Year as well. And that's off the back of the spaving offering that we were talking about last time. So that's quite a unique offering in the marketplace that not many, I don't know any other brokerages are doing that. So we put that forward as a way, that we're giving back to the community and pricing loans for clients that aren't our existing clients. We're opening that up. So there's some really good initiatives there. So
That's cool. It's a big congratulations to the whole. It's because it's a team effort, right?
correct.
Yeah, wouldn't be able to be nominated for any of this stuff without the greater team.
Yeah.
And it just shows that we do a good job, especially I think the customer service award.
Yeah.
It's just a big testament for what you've built over time.
Yep.
Like over
and
300
that's
now,
all of
right?
us, right? And that's off
Yeah.
the back of those Google reviews. So we put that forward as part of our submission to say, the growth of those Google reviews. And, it's tricky to get Google reviews from clients. Everyone's busy, right? But it's really awesome to see so many people spending the time and leaving us a review because they've had a really positive experience with our business.
I think it's tricky to get the reviews, but I think the reviews that we're getting are so detailed. They're
Correct,
not just like, they sorted a loan out for me.
Yeah,
But actually, like you go and read those, they're just
There's a lot of detail.
bang,
Yeah.
It's like this is what they've done, this is how it's changed, and that's a massive.
And look,
Yeah.
it'd be good if we came away with the cookies, but I guess, either way, it'd be great to be part of the night. It's a really good opportunity to see a lot of other industry peers and, people that have mentored me over the years and colleagues in the industry. So, but it's a great testament to the team just to get some of those accolades and good excuse to throw it on the socials and talk about it on a
100%.
podcast and look, it builds credibility with our client base and referral partners. So, they can see that we take this seriously. This is our business. This is our passion. And we love what we do. And we're getting recognised for that.
Because you've been very selective about what awards you go. Because I think there's a lot of people that just put their names in for every single award and hit and hope. But I think just be the
And
ones
look, I'm
that
a
you actually-
numbers man, right? I'm not very good at writing submissions. So
No.
we did get a bit of help from one of our team to write those submissions to make them sound like it wasn't written by a broker.
Yeah, but I guess it just goes to show that you have nominated yourselves for the awards that you actually feel passionate about.
Yeah, correct.
And you actually are making a difference, like a true difference, and just not wanting a little badge on you. So it's like this is
that's
what we
right.
are actually passionate
exactly.
about. So I think that's really cool. There's a couple of other awards coming up. Bank West, then MFAA coming up as well. So I think we've put a few nominations in for those as well, which will be pretty cool.
Yeah, that's it.
Sweet. Anything else exciting happening for the rest of this month, Simo? No more golf games. Thought we'd give you.
He's on a course.
He's on a course. Yeah.
Hopefully some more of those.
Yeah.
But no, I think it's just. I think it'll be. I think it'll just be a little more busier, more positive in the market, good sentiment. So I think it'll be a busy year anyway.
We're coming up to Easter. That's always. I can feel
Bit
it
of
already.
disruption,
Yeah,
The inquiry level of inquiry is just coming up.
It's been really strong.
Yeah. Yeah. Sweet. Cool, guys. Well, I'm going to cut it at that one because that's where we've got more to talk about, but we'll save that for later. Before you guys go, plug your socials. Where you go, Simo? Plug your socials. Instagram.
Simon.mortgagebroker on Insta.
It's actually doing really well. Actually really loving your posts
thanks,
on
mate.
there. So you can tell your
Thank you.
social media manager she's doing a good job.
Thank
Actually
you.
really
It's
good.
definitely
Really
Pay
mate.
rise soon.
Yeah. Hopefully she doesn't hear this.
Hopefully she does. She should be following the podcast. Adam,
Oh, mine's just the Merge Finance, just wherever you want to find us.
you are on TikTok, but
Every
you know,
every social.
It's
Breaking
gone
Banks.
missing on TikTok. But anyway.
Breaking Banks will be back soon.
Yeah. But yeah, mine, Lou Cashby Mortgage Broker, Instagram, TikTok, Facebook. And also my First Home Buyers Club. If you are a first home buyer listening, it'd be worth having a look at my Facebook group, First Home Buyer Club Queensland on Facebook. It's free info. Jump on, get the info you need to make better educated decisions.
amazing. And at Dion Finance Specialist on Instagram. You can find this on all the normal socials and find me on LinkedIn. Guys, again,
Thanks,
the
mate.
information on this podcast is very general in nature. It does not take into consideration any of your current circumstances. If you want more information, just come and have a chat.
Yep.
It's free. You don't need to be scared. And yeah, just go from there. But thanks, gents, for joining us on another
mate.
panel.
Thanks, mate.
Look forward to seeing you all next month. And I reckon there's another big month ahead. A few changes I think will be happening in the lending space.
That's
Definitely.
exciting.
Thank you.
Cool.
Thanks,
Thanks,
guys.
mate.
Cheers, guys.
Bye.